This material has been reproduced and communicated to you by or on behalf of Deakin University in accordance with Section 113P of the Copyright Act 1968. The material in this communication may be subject to copyright under the Act. Any further reproduction or communication of this material by you may be the subject of copyright protection under the Act. Do not remove this notice.
One? Yeah. Welcome. Yeah. We haven't started yet. Yeah. Finance 101. Yeah. Okay. Thanks. Okay, let's get started. Good afternoon, everyone. Welcome to MAF 101, Fundamentals of Finance. This is a first-year finance unit offered by the Department of Finance. My name is Vincent Xiang. I'm unit chair. So from today, I look forward to working with you guys in the following 11 weeks. Okay? So before our study journey formally kicks off, I wanted to briefly introduce myself, the unit team, and also give you guys a quick overview about this unit. Okay? So I joined Deakin about 10 years ago after I received my PhD in finance from Monash University. For my teaching at Deakin, I mainly taught the postgraduate finance unit. So indeed, this is my second time teaching this first-year finance unit. I'm still very excited, and I'm sure that by working with you guys closely, by inputting our hard work together, we can achieve excellent results at the end of the trimester. And as a unit chair, my job is to help you guys out. Okay? So whenever you have questions, whenever you feel any sort of difficulties, please contact me straight away. Please don't accumulate your question, your problem, till the end of the trimester. It's going to be too late, okay? So on the slides, you have my contact detail, and also I already arranged the Friday from 10 to 11 for the consultation. So if you have any questions you would like to discuss, you would like to have a chat, to talk, so please jump into my office. My office is in building LB, okay? Room 4231, okay? And I also try my best to be flexible. So if you want to see me talk during some other time, please shoot me email first, okay? And also we have a lovely, the unit team, teaching team. I will be working with Annette and Daisy to look after the seminars at Burwood campus, okay? And meanwhile, Annette is also doing the online seminar on Thursday at 6 p.m., okay? And all our class, lectures, and also the seminar class will be recorded and uploaded to Cloud Deakin, just in case you want to access to the material again, so you can find the lecture recording, the seminar recording in our weekly the topic folder, okay? And my colleague Chris and Stephen will be looking after the students' seminars at Geelong campus and the Warrnambool campus, okay? So as a unit chair, so I should be always the first, the contact point whenever you need any sort of help. So please don't hesitate, contact me. Okay, so as a unit chair, I only have one simple requirement, that is nobody is allowed to fall behind. So please let me just reiterate again. If you have any sort of questions, difficulties related to this unit, so please give me a call, send me email, or leave your question to discussion forum. Okay? Is that clear? All right. And here we go. This is a quick overview about this unit, and it is a game plan for our trimester, for the entire trimester. Today, for topic 1, we're going to take a baby step. We're going to learn and address some pretty basic and elementary issues related to finance. Okay? And for topic 2, we will be learning the present value and the future values. So essentially, we want to introduce a key concept in finance, and that is called the time value of the money. Okay? So the key economic question we want to explore is, why does money have a time value, right? So by exploring this concept, we can learn and understand how value changes along as we're traveling along the timeline. Therefore, we're going to learn and discuss the present and the future value. Please remember, the time value of the money, it is a fundamental concept underlying entire finance. Okay? So without this time value of the money, we wouldn't have any financial system. The financial system will collapse. Okay? So we don't even have the financial market. We don't even have an interest rate. Okay? So all those financial concepts are pretty much built upon the time value of the money. Therefore, we're going to allocate 2 weeks time just exploring this key underlying the foundational concept. Okay? And of course, for topic 2, that involves some mathematics. So I know nobody likes math, including me, but what I'm trying to do is I try my best to keep everything as simple as possible. Okay? So as a finance student, I believe that understanding the intuition behind is way important than doing calculations. Okay? So in terms of a calculation, we have a formula sheet provided. Okay? So there's nothing to worry about, for your exam, right? So because the formula sheet is already provided. So what I want to reiterate, emphasize is the intuition behind. Why do we calculate, for example, future value like this? I want to explore, clarify the intuition behind. And I understand, my belief is that if we understand the intuition behind, then we can handle all calculations pretty easily. Okay? For topic 3, we're going to take a tour and visit the overall financial system, financial market, and also meet and visit those financial institutions. Okay? So what we are going to learn is to explore and understand their unique function, their unique roles played by different financial market and different financial institutions. Okay? So basically, we take a tour to visit the financial ecosystem. Okay? And after that, we're going to spend 2 weeks learn and talk about the risk and the return. Okay? So initially, we will introduce the measurement issue. Okay? So we identify how do we measure return and how do we measure risk. Okay? Why is that important? I know from an investment perspective, okay, investors are chasing for returns, okay? But this statement is incomplete. If we study finance as a finance student, we should know that it is meaningless just to talk about a return without mentioning risk. Okay? So as a finance student, please remember there is always a trade-off between risk and return. Okay? So if the market is in equilibrium, if the market is functioning well, if the market is efficient, we should expect a positive the risk-return relation. So meaning, without taking additional load on risk, we cannot claim additional return. Okay, so that is the key, the risk-return relation underlying the entire financial market. So at this stage, it's too advanced. So please just remember, it's simply meaningless to talk about a return without mentioning risk. Therefore, we're going to spend the 2 weeks' time on this topic. And sequentially, we want to build this theoretical relation between risk and return. Okay? Is that clear? Okay, great. For topic 5, we're going to learn the different channels for companies raising capitals. Okay, so those we learn and discuss the different alternatives for fundraising, basically. Okay, and for topic 6, we're going to learn the foreign exchange, pretty much the foreign exchange market. Okay, the foreign exchange market is offering the unique and the important role for the global economy. Okay, if you've already done your macroeconomics, remember when we talk about the GDP, what is the last term? The net export, right? So without a foreign exchange market, a liquid, active foreign exchange market, we pretty much wouldn't have any active international trade, right? So the foreign exchange market is offering a very important economic function to the global economy. And in addition, if you believe stock market is important, okay, but in terms of trading volume, okay, the total amount, the dollar allocated to this market, the foreign exchange market is way bigger than the stock market, okay, because it is a global market, it is a 24 hours non-stop market, okay. So that is the key reason why we introduce the foreign exchange market as into our curriculum. Okay. Topic 7, fintech. Okay, so in the recent years, we see a lot of great innovations in this field. Okay, so that's why starting from this year, we revise our teaching curriculum. We include the fintech as a separate topic into this unit. So we're going to learn those great innovations in the recent years. You can name it, such as the blockchain, right? The cryptocurrencies, okay? The P2P, peer-to-peer finance, and also like a startup, the companies, okay? So those are the fascinating area, the great financial innovations in recent years, okay? And finally, for topic 8, we're going to have a special topic on financial ethics, okay? So we believe that it is important for the first year commerce student, finance student to learn the importance of ethical issues. So as such, we're going to have an external guest speaker to share with us the industry practice about the financial ethics. Okay? And I wanted to make it clear, the final topic on ethics is not examinable. Okay? But for the rest of the topics, will be covered in our final exam. Okay, so is that clear? So that is a quick overview about this unit and the game plan for the entire trimester. Okay, so during our class, if you have any question or if I'm not clear, please raise up your hand. You are welcome to jump into our discussion always. Okay. All right, let's talk about the housekeeping assessment. Okay. So there are 3 assessment components in this unit. The first one is the quiz. Okay? And in total, we're going to have 4 quizzes. The quiz will be purely multiple choice questions. Okay? So we have a week 2, 4, 6, 8. Those weeks are quiz week. Okay? So basically, for each quiz, that covers 2 weeks, prior weeks topics. Okay? So the reason we allocate this quiz is we really want to make sure that we all keep up with our learning schedule. We don't want to see anybody fall behind. Okay? So each quiz gives us 2.5%. So in total, we allocate the 10% on quiz. Is that clear? Okay. Second, it is our assignment. Okay, so that gives us 40% of total assessment. Okay, so just a clarification, the assignment will be individual basis. Okay, and the assignment document will be up by week 2. Okay, so most of the questions are calculation-based questions, and we have one discussion question related to the issues in the financial market. Okay, and finally, we have a 50% on final exam. Okay, the exam will be a proctored exam. Okay, but the formula sheet will be provided. Okay, so more information will be provided as we are approaching to the trimester end. Okay, is that clear? There's no hurdle. Okay, so meaning you don't have to pass the exam to pass the unit. If your total marks accumulated from all assessment components about 50%, then you pass, right? But I really want to emphasize again, I don't worry about you guys pass. What I want to achieve is I want to see a greater proportion of distinctions or high distinctions. That is my teaching goal. Okay, so I think if you follow our materials in class, if you attend seminars, I never worry about the fail or pass. Okay, so that is not my objective. What I want to achieve is a higher distinction rate or high distinction rate. And I also want to see more of you are, choosing finance as your major, perhaps. Okay. All right. So our expectation from you. So we need to attend the class activities, including the lecture and the seminar. Okay. So if you miss the lecture class, so the lecture is recorded. Okay. So that will be uploaded to CloudDeacon on Tuesday, late afternoon. Okay, and also we need to attend the seminars because that is the opportunity you can bring your question to the class. Okay, starting from this year, we make the seminar from 1 hour to 1.5 hours. The reason is we want to have a more discussion with the students, with you guys, and you have more opportunities to engage, to do the questions in class. Okay? And I also strongly recommend before attending the class, the seminar class, you should also do your preps. Okay, so please also do your preparation and bring your question into the class. Okay, and the seminar class will also be recorded, and just in case you want to revisit. Okay, the textbook is here, it's listed here. You don't need to purchase the physical copy, the hard copy, because all learning material, including the textbook, reading material, are already provided, will be uploaded to our weekly topic folder. Okay? So you can pretty much find everything you need to know about this unit on the CloudDeacon website. Okay? And we also have a discussion forum, and I'm sure that you must be familiar with that because I already see a lot of questions posted there. Okay, so this is also an alternative way to clarify your questions. Okay, so whenever I see your questions, I try my best to reply you within 24 hours. Okay. Okay, and we also have a range of support offered by the university is free of charge. For example, we have a Math Mentor program. We also have a PASS, peer-assisted the study program, okay, which are also available to all students. Okay, so if you need any sort of help, you're also welcome to participate into the program as well. But please remember, I'm the unit chair, so if you have any difficulty, so please contact me straight away. Okay, so I'm happy, my door is open all the time. Okay. All right, so that's pretty much an overview about this unit. Is there any questions before we formally start? If there's no questions, our study journey formally kicks off. Okay? So for topic 1, those are the learning objectives we wanted to tick by completing today's class. Okay? As already mentioned earlier, we're going to take a baby step and address a few pretty basic and elementary issues related to finance. Okay? So for example, what is a finance? What will be the corporate objectives in modern society, and etc. Okay? So let's take a look. What is a finance? Before we provide a definition, before we define what is a finance, I wanted to share with you some interesting example. Okay? So the first example is an interesting observation we see from the market, we see from the data. Okay? So suppose I'm a big fan of car industry. Okay? So what I do is I make $1 investment on the biggest car maker, the Toyota, about 10 years ago. Okay? And over my holding period, investment horizon is 10 years, so I spend $1 I invest on Toyota in 2012, and then I sell my share last year March. Okay? So over the 10 years period, I can see that my initial investment increases from $1 to $3.15, right? So pretty much I tripled my initial investment, which is considered as a pretty decent return, right? And alternatively, if I don't take a position on a single company, I thought it's too risky, okay? Alternatively, I can invest on the whole industry, okay? I can do this by investing on a fund, okay? Tracking the performance of entire car making industry, okay? So this fund is available. It is called CARS, okay? So basically, they provide exposure to investors with the exposure to the entire car industry. If I do this, I increase my initial $1 investment to pretty close the number, $3.06. So the performance are pretty close, you can see, right? And then what I show you in the second picture, you know who is Rockstar, right? Now clearly the performance of Toyota is overshadowed by the red line, right? Who is the red line? Tesla. Okay? So if I invest the same $1 at the same time, 2012, and I hold my position for 10 years, how much I receive? That becomes $188. Okay? It's totally non-comparable, right? If we have to do a comparison between the Toyota versus Tesla, or even the entire car making industry versus Tesla. So the question is, what could be the factors that can explain such huge return difference between Tesla versus Toyota, between Tesla versus the entire car industry, right? So I know everybody talk about the clean energy issue, we talk about the global warming issue, but is that enough to justify such a huge return difference? We don't know, right? And I know someone is saying the Tesla price simply reflect a price bubble driven by irrational buying, right? But what could be the evidence? Okay? So this is a classic issue we study in finance. Okay? Second example, related to what is finance. Here, we are comparing the performance of two stocks. Okay? As you can see, we are comparing the performance between the two stocks, the Martin product. The second stock is called US Electric. Okay? So what we can see is that the return performance is no longer stable. Right? So the performance or the return of the stock is depending on the economic state. Right? As you read the table, you can see clearly if the economy is booming. Okay? So the US Electric is able to deliver a pretty decent return at 20%, say, over the next year. the 20% return is considered pretty decent return, right? But in contrast, if the economy is booming, the margin product is able to offer 110%, meaning you are able to double your initial investment, right? But in contrast, if the economy is in recession, the US Electric is offering 10%, but the other company, the margin product, there's a 60% loss, right? So as a rational investor, we want to invest rationally, right? So rationally, as a rational investor, the question is which stock we should pick. If we are not engaging in any speculation, we want to invest accordingly, rationally, which one we want to pick. Okay? So it seems to us it's a little bit confusing, right? So here we have to deal with a greater amount of uncertainty, right? Not only return is not stable. Look at the economy, it's not stable. Okay? So the probability of booming economy is 20%, right? Whereas we have 30% for the economy to heading into a recession. So there are great amount of uncertainty associated here, right? So the question is, how do we make informed decision confronting with the uncertainties? Okay? So this is another classic example we want to learn, we want to study in finance. Okay? So the good news is by completing this unit, okay, so we are able to make a rational, informative decision to solve this problem. Okay, so those are the, I just wanted to share with you what we learned as a finance student, what will be covered. And those are the classic issues covered in finance. Okay, so now it's a time to formally define what is a finance. Okay? Finance is an art and a science of managing capital. Okay? So the question is, why do we need art and a science for capital? Any thought? Any opinion? So why do we need art and a science of managing capital? The key fundamental reason is capital is a limited resource. Okay? And there's a cost involved. Okay? Suppose if you borrow your capital from the bank, you have to bear the cost. Right? So you have to make sure that when you deploy your capital, when you spend your capital, invest your capital, you have to make sure that the expected return is able to cover the cost. Right? Therefore, we need a scientific approach for the investment decision. So as such, finance is an art and a science of managing capital. Okay? It is all about making decisions. Okay? It is all about making rational decisions, optimize the decisions. It is a study of how individual or business or even institutions acquire, that means we respond. Okay? Spend, that means we invest the capital. Right? And manage the financial resources, meaning the capitals, right? So finance is also closely related to economics and accounting, okay? So as a finance student, I'm confident that as we take a deeper dive into this unit, where if you're completing several follow-up studies related to finance, I'm sure that you will have a better understanding, where you can even have your own definition about what is a finance. Okay? So as such, in this unit, we cover the following areas, related topics, okay, related to what is a finance. Okay? So we already cover those weekly topics schedule. Okay? Now let's take a look. What is a corporate objective? Okay? In the modern society. Okay? The first question that I want to ask is, who is the company responsible for? Okay. Or alternatively, who is the owner of the company? Is that managers? Is that CEO? Or shareholder exactly? Okay? The company is funded and owned by the shareholders. Okay? That's very good. So if we understand this, then we should understand the ultimate goal for the company should be maximizing the shareholders' value. Okay? Because the shareholders are the owners of the company. While the company's decisions are made by the managers, but the company itself is owned by the underlying shareholders, right? Therefore, the implication is for all related decision-making made by the managers, the objective should be maximizing the total value of the shareholders. Okay? So that is the modern view of the objective of corporation objectives. We should maximize the shareholders' value. Okay? And in the modern society, we believe that the companies or corporations, we should take a broader responsibilities. Not only we are responsible for shareholders, the corporate, we should take a broader issue responsibilities. We should address the environmental issues, for example. Okay? We should be socially responsible. Okay? And that will be, saying this is not in conflict with maximizing shareholders' return. And indeed, if we are talking about the broader responsibility of the corporate, and indeed what we are doing here is we are maximizing the long-term value of shareholders. So rather than take a short horizon perspective, we are addressing the long-term issues. Okay? So we can see that clearly everywhere, even in our daily life. Let me give you an example. Okay? So what I show you here, it is a everyday grocery shopping. Okay? So this is a organic milk. It's available on Woolies shelf. Okay? Just take a look the description of this milk. What is the first sentence on the description? This milk helps fight global climate change, right? Has nothing to do with the milk, right? And take a look at the follow-up sentence. The milk is crafted from a carbon neutral farm, right? Why they have to say this? Because they want to provide a clear message to the society, to the investor. They are concerning about a social responsibility. So as a corporate, they are addressing the broader responsibility issues. They are addressing climate change issues. They are addressing environmental issues. That is considered as a long-term value maximization process. Okay? So from the modern society perspective, the company's manager is not only responsible for maximizing shareholders' value, and indeed, we are taking broader responsibilities to address social responsibility issues, to address those environmental, social issues. Okay? And this could be viewed as a classic example here. So as such, the companies, the corporations, they need to treat the all stakeholder the better, right? Including employees, including the all stakeholders along the supply chain, right? And keeping customer happy, and even being a good corporate citizen in the business world. Okay? So by doing this, what we are doing here is we try to maximize the long-term value of the firm. Okay? Is that clear? Okay, great. So after clarifying the objective of companies, so we already mentioned that the managers is responsible for making decisions, right? So all the time when managers are making decisions, we should also always make sure that our decision-making process, we take into account the corporate objective function into consideration. We should always add value to our shareholder, to add value to our overall, the whole society as a whole. Okay? Okay? There is a saying, so as a finance manager, we should always maximize accounting profit or the share price. Okay. So the trick here is there is a difference between the accounting profit and the share price. Okay? So we understand that the corporate objective is to maximize the entire firm value, right? And that is different from the accounting profit for the following reason. One, the accounting profit is only indicative of what happened in the past. Okay? It doesn't say anything about the future. Okay? And second, the profit is not of cash. So if you've already done your accounting 101, you know when we calculate the accounting profit, so we also include the non-cash component, such as depreciation, right? Therefore, the accounting profit is not economic profit, okay? And also, the most important reason is that the accounting profit doesn't take into account the timing and the risk of cash flows, okay? As a finance manager, we should always make sure that by investing on a project, we can make economic profit to the company. So saying the economic profit is we have to incorporate the timing and the risk of cash flows, right? So as a finance manager, our objective is not to maximize accounting profit. Rather, we should maximize the economic profit. Okay? So when we are talking about the economic profit, we have to take into account the timing, the magnitude, and the risk of the cash flows. Okay? So we're going to introduce a methodology. How do we do this? So basically, we need to make sure that as a finance manager, we should only consider the project that has a present, the positive, the net present value. Okay? We're going to define this term in the following weeks. Okay. But for now, let's just remember this. We need to maximize economic profit. Okay, so the economic profit, we have to consider the timing, magnitude, and the risk of the cash flows. Okay, and as a measure of a total value of the company, if the stock, if the share are traded on the exchange, we can easily calculate the total value of the company, okay, using this formula. Okay, so we know the latest price, the updated price for the shares, right? And then we also know how many shares has been issued by the company, right? And then we take the product of these two, and that figure will be the total value of the company, right? And that it is available, can be observed from most of the financial database, right? So for example, if you look at the Google, we can easily see that the total market cap, etc. Financials. So market cap, that is exactly what we are calculating here. Okay? So market cap is the total market capitalization. Okay? So we use the share price times the total number of shares outstanding. Okay? Okay. So in order to maximize the long-term the value for the company, for the shareholders, okay? So managers, they need to make the following 6 decisions, okay, in order to be success, okay? But for this unit, we only focus on the 3 key decisions made by the finance managers. And that include the capital budgeting decision for investment, the capital structure decision for financing, and finally, the payout policy for distributing the profit. Now let's go through each of these three decisions one by one. Okay? And indeed, those three key decisions are interrelated and affecting each other. Okay? Now let's take a look at one decision one by one, and then we clarify the impact from the other, how those three decisions are related each other. Okay? So first, capital budgeting decision. So key issue we need to solve here is which project we want to invest. Okay? So it is all about how do we make a budget for the capital. Okay? So the reason is the company, we only have a limited resource, limited capital. Okay? No matter it's financial capital or human capital, they are all confronting with a constraint. Okay? So therefore, we have to make sure that we deploy our capital in an optimized approach. Okay? So key issue we want to solve here is which project we want to invest. Okay? And usually it consists of the following three steps. Number one, we want to identify the potential investment opportunities. Okay? So we want to shortlist those projects before we're doing any evaluation. And in step two is we want to examine the potential profitability for each of the project. Okay? So by doing this, again, we need to calculate the net present value, or NPV. Okay? Because NPV is indicating us the true economic profit provided by the project. Okay? And then as a golden rule is that as a finance manager, we should only consider those projects with a positive NPV, right? Because by investing on positive NPV project, and that means we add additional economic value to the shareholder. Okay? And finally, after we decided the project, then we need to implementing and monitoring the selected investment. Okay? So that is all about the capital budgeting decision. Okay? Is that clear? Okay. Now we move to the second decision. It's called the capital structure decision. Okay? Let me give you a quick explanation. Why do we need a capital structure decision and how it's related to investment decision? Okay? If you already done your basic accounting, okay, first year accounting, the basic accounting identity relation is assets equals what? Assets equals L plus E, right? What does this say? Liability and equity. And implication is on the left-hand side we have assets, right? So the implication is in order to finance the assets, we have two sources of capitals. One is liabilities, means borrow. We borrow from the debt holder, right? Second, we can issue shares. We can raise funds from shareholders. But essentially, those are the alternative way to fund additional assets, right? Remember in step one, we decided the assets, right? So number two, we need to solve is where we get fund, right? And that decision will be reflected on the capital structure decision. So basically, it's telling us the structure of your capital. What proportion of your capital are borrowed from the debt holder, from the bank? What proportion of your capital you raise funds from the shareholder? It is a mixture of these two reflect your capital structure decision. Okay, is that clear? And of course, this decision will affect the first capital budgeting decision. Why? Because once you choose your source of capital, you know the cost of your capital. If I borrow from the bank, I know the bank charged me 6%, right? I have to make sure that my capital budgeting decision, my investment is able to cover the cost, right? And hence, and these two decisions are interrelated, affecting each other. Okay? Right? And on this slide, here are some recent, the current example for those major companies. They just did their investment decision and also released the financing decisions. Okay, so as you can see that for the financing decision, for the capital structure decisions, there's no unified approach for deciding capitals, right? Let's take a look at those famous examples. If we talk about the Tesla, okay, so they want to build a new plant for their super truck, right, electric truck, and they decided to make a plant in Texas, right? And then what they do is they want to raise funds from their shareholder. Right? That can be easily understood, right? Because we know that there's a strong demand in the market. The investors, they want to buy the Tesla share. They want to pay the premium price for Tesla share, right? So Tesla, they can easily raise funds from their existing or the new shareholder, the base, right? And that is completely different from Amazon. Just take a look at Amazon. Okay? For their new project, cost $1.2 billion, what they do is they don't talk to anyone. They don't talk to shareholders. They don't talk to the banks. What they do is they use the internally generated fund for the new project. Why? Why are they doing this? Any idea? Why are they doing this? Save the interest cost. That's exactly the punchline. Because it's cheaper, right? Because those money are internally generated, right? You don't have to pay the interest. You don't have to increase your shareholder base, right? You don't have to increase the shareholder base to share your future profit, right? It's cheaper. Your existing product already enough generating some cheap profit, cheap money, right? So why not we just using those cheap source of capital, right? Therefore, Amazon, they decided to use their internally generated cash, okay? And just take a look at the Intel, the chip maker, okay? What they do is they borrow $600 million from the external debt holder, right? It seems to us that they don't have enough internally generated cash, or it's going to be costly or difficult to raise additional funds from the shareholders, right? It seems that they have to borrow from the bank or creditors to solve the problem. Okay? So what I'm trying to say here is that we can see clearly there's no unified approach for financing decision, right? It's all depending on the company's the scenario. Okay? And finally, payout policy. It is all about how do we distribute the profit. Okay? So after a while, we already invest on a profitable project, right? And we already sorted out the finance, right? And a few years later, the project started generating the profit or cash flows. Then the question is, how do we utilize the cash flows? So the key question is, should I distribute the cash or profit back to our owner in form of dividend, or should I reserve the cash for future growth? Okay, so that is a big question related to here. Okay, and again, there's no unified approach for deciding this dividend payout policy. Okay, let me show you something. Okay, the same example. Okay, if you take a look at the Toyota, you can see clearly the dividend yield is 2.7%. So meaning, if the share is at $100, the Toyota is paying $2.70 in form of dividend. They distribute back their profit to the owners in form of dividend, right? How much dividend for Tesla? Nothing, zero, right? Tesla is not the only one company not paying dividend. We see the growth company in early stage, such as Google, such as Apple, okay, they never pay dividend in their initial stage. Why? Any thought? Why those companies, they never pay dividend? Yes, please. Exactly right. Because they are young firms. They are confronting with great potential for future growth, right? So they are thirsty, they are hungry for the money, right? So they really want to use the money for future investment project rather than distributing back the cash back to the owners, right? So what I'm trying to say here is there's no unified approach for the payout policy as well, right? So therefore, as finance managers, they need to analyze their situation and make a thorough decision in terms of the payout as well, okay? So when we making the payout policy, we should be bear in mind there could be a free cash flow problem. If the company is sitting on a massive amount of cash, there could be some risk concern associated here. Okay, so the situation is called the risk of managers holding cash for some misuse. So that could be a potential concern, right? Okay, so when we talk about the dividend, okay, so we have to talk about the taxation, okay? So normally the dividends are treated as an income, okay? So in most of the countries, unfortunately, we double tax on dividend income. Why? Remember, the dividend is paid out of profit, the company's profit, right? The company already has been taxed once, right? The company has been paying corporate tax already before generating those profits, right? And after they pay tax, company level tax, they distribute the money back to shareholder. If we tax those money again, basically the dividend are double taxed, right? So, and that is indeed what happened in most of the countries, okay? But what is unique in Australia is we introduce and implement a dividend imputation system. So the reason we have this system is we want to avoid the double taxation. So what we do is after I receive, say, $1 dividend, we can calculate how much tax at the company level has been paid already, right? And for those portion of tax paid at the company level, we can utilize that as a credit to offset the personal tax bill. Okay? So indeed, effectively, by using the dividend imputation system, we can avoid the potential double taxation. Okay? So that is unique here in Australia. Okay? Now, let's talk about the legal form of business. Okay? So those are pretty straightforward. Okay? So those are the common business format from simple to complex. We can have a sole trader, sole proprietorship, partnership, and corporations. Now let's take a look one of each. Okay, so we're going to compare the advantage and the disadvantage of each of the business format. Okay, so for the sole trader, clearly the advantage is simple to set up, right? What you need to do is you just apply an ABN number, for example, in Australia, right? And then you have your sole trader business, okay? And subject to a few government regulation, meaning the regulation in terms of regulation is a minimum, okay? Then the tax will be treated as an individual tax, okay? So, but for the key disadvantage is there is no clear cut. There's no clear boundary between the owner and the business. Okay, so the business, the owner will take ultimate responsibility for the business. So because there's no clear the boundary between the business and the owner. Okay, so that we can have all the disadvantages here. Okay, and then the next format is a partnership. Okay, so the structure is getting a little bit complicated. Okay, that involves a cooperation from a number of partners together. Okay, so we can see the partnership business is very popular for those, the business involves high professionals, such as the medical clinic, the accounting firms, the solicitor, the legal firms. They're all taking the partnership business format. Okay, so the advantage is similar as before. They're easy to form. So the regulation is also very light. But disadvantage is similar as before, right? So there's no clear cut between the partners and the business. Okay, so the partners have ultimate unlimited the personal liability for the business the debt. Okay, so if the business bankrupt, right, the creditors, they can sue the partners. Okay, and finally we have companies. Okay, so the advantage of companies, we are able to address all the disadvantage associated with a sole trader and partnership business, right? And we know that for the company is owned by the shareholders, right? But the shareholders' liability is limited. Okay? So the maximum loss we can incur as a shareholder, it is my initial share capital. If I invest $100 to the company, all I can lose is $100. I don't have any additional potential liabilities involved. It is different from the other business format, right? And it is separate and distinct from the owners, right? So it is a limited life, a going concern, okay? It's easy transfer of ownership, especially if the stock is listed on the stock exchange. We can easily transfer ownership by selling the share, by selling and buying the shares, okay? But the disadvantage is compliance. Okay, so in terms of the regulation, we have a corporation law. I'm sure that if you are doing commerce degree, you will learn the company law, corporation law in your study. Okay, so we have a entire the regulation or legislation governing the operation of companies. So the compliance will be complicated. Okay, all right. And next, I think this is our final issue we need to address is the tax. So we need to work out how to calculate the tax. Okay, so this is a sort of a roadmap. How do we deal with the tax? Okay, it's depending on a few parameters. The first, we need to make a distinction. What is the format of business? So the question we ask whether it is for individual taxation or if it is for business tax. Okay, and also we need to calculate the tax income, taxable income. Okay, and also finally we need to identify the tax rate. Okay, so let's go through some specific example. Here for individual tax. Okay, so what we need to do first is we calculate the taxable income. Okay, the taxable income is not the same as your income. Okay, it is indeed the difference between the assessable income and allowable deductions. Okay, so difference between these two, it is a taxable income. We're going to pay tax based on the taxable income. Normally, if I'm an employee of an organization, when I receive my pay, the tax has been already paid. Okay, it is called PAYG tax, pay as you go. Okay, so now let's take a look. How do we calculate the tax for the individual tax? Okay, so in Australia, we adopt a progressive taxation approach for individual income tax. You can see clearly we have a higher tax rate if your pay is higher. Okay, so for example, for the initial step, if your income were for the first income within the first step, okay, the threshold is 18,200. For those portions, there's no tax. It's tax-free money. Okay, if your income is above the first threshold, when you come to the second step, okay, we need to pay 19% tax rate. Basically, 19 cents per dollar will be charged only for the portion within that range. Okay? Then as your income is getting higher, then you're going to pay 32.5% for the next band. Okay? So first, we need to identify the band. right? And then we know how much tax we need to pay. So my question is where we get this $5,092 from. So we know that it's going to be a progressive tax rate, right? Because if we are our income is in step 3, that means we have been paying 19% tax for those portions, right? So as we're going through the second step, we have been paying 19% for those portions. As you can see, the $5,092 is exactly how much tax has been accumulated for the second step, right? So if your income belongs to step 3, so what you do is you calculate that is your base tax $5,092 plus then the 32.5% for the additional tax. Okay? And then I'm sure that you can understand and those $5,000, $5,092, and also the next band, $29,000 and $467. Okay? All right, let's take a look at the example. Okay? So if I'm working as a sole trader, okay, and we know that the tax will be charged at the income, personal, individual income tax. Okay, so my pay is $63,000, and meanwhile, during the financial year, I also incur some work-related expense. Okay, so work-related expense can be utilized as tax offset. Okay, so first thing first, we need to calculate the taxable income, and that is the difference between the assessable income and those work-related expense. Okay, so my taxable income will be $62,000, right? And then what we do is we need to identify which band our income belongs to. Okay, clearly, $62,000 belongs to step 3. Okay, so by reaching step 3, we have already accumulated the base tax, $5,092, right? And then we just calculate the incremental. We take the difference between the $62,000 with the threshold, okay? The ending point of previous step, right? And then we're going to pay 32.5% on top of this, right? And then hence our total tax payable at the personal tax level will be $10,617, okay? Right? And this is how we work out the personal income tax. Now what about the partnership? Okay? So just remember this, for the partnership business, they cannot return any earning, any profit. They have to distribute all the profit back to partners. Okay? It's different from companies. Okay? So once partners, they receive their distributed the profit, then they will be taxed at the individual income tax level. Okay? So essentially, the partnership business is pretty similar to individual income tax, right? So we just need to solve additional hurdle. How do we split the profit? Okay? As you can see in this example, our arrangement is for the partnership business, Jesse owns 90%, okay? And Simon owns 10%. So meaning for whatever profit, okay, distribution, the Jesse will receive 90% of profit, right? And the remaining 10% belongs to the Simon, right? And then we can work out the personal income tax accordingly. Okay? Now let's take a look at the financials. So it's clearly written on the slides. The income, $600,000, right? And meanwhile, the partnership business also incurs some expense, right? Such as interest expense, some the wage expense, depreciation expense. So the net profit for the partnership business is total $250,000, right? And then the partnership business, they have to distribute entirely all the profit back to the partners, okay? Right? And according to the arrangement, for the entire $250,000, Jesse will receive $225,000 for their portion, right? And Simon will receive their share, $25,000, right? And then we can work out the corresponding tax for each of the income. Okay? So I leave it to you as a practice at home, okay, to solve the personal tax level for Jesse and for Simon. Okay? And then finally, for the company income tax, okay? So it is all depending on the corporation law. Currently, for the fiscal year, the company tax is depending on the company's turnover. So turnover is a measure of company's business activities. Okay? So if the total turnover for the company is below the threshold, then the company will be paying the 26% as a corporate tax. Okay? So the threshold is $50 million. Okay? If the turnover is larger than $50 million, then the company tax will be taxed at the 30% level. Okay? So here, well, we are talking about the company, the business level. Okay? So here is an example. Okay? So the income $250,000, and then because the total income is below the threshold, right? So therefore, we know that the applicable rate is 26%, right? So here, the tax payable, the corporate tax bill will be at the $65,000. Okay, so that is the company tax. Okay, the company need to pay. Okay, it is different from the income tax. Okay, so I think that brings us to the end of our first class. Again, it's my great pleasure to meet everyone in class today, and I wish you a successful trimester ahead. And I look forward to seeing you guys in our seminar. Thank you. Yes.
So like one computer like this one, they say, so this is that the assignment one, or where is the question for the place I'm looking for the assignment question for the, this?
No, assessment will be different. It is about a quiz. As already mentioned, the quiz will be in week 4, 6, 8, right?
I think, yeah, assignment one is going to be on week 1 or week 2.
Yeah, the topic will be covered, will be week 1, week 2.
So where's
but the actual quiz will be in week 4.
So where is are we going to be in class C? Or?
No, it's online. I will provide more instructions. And indeed, here you already see the instructions. See? You see the instructions here. So you will... Yeah. So that is the time for the quiz, and that will be the topic covered. So we want to make sure that we have enough preparation period. So we learn the topic 1 today, topic 2 next week. We're going to do the exercise in our seminar for topic 1 next week, and in week 3 for topic 2. Therefore, we are fully prepared for the first 2 topics, right? And then come to week 4, we do the quiz for these 2 topics.
So right? For the quiz, is it going to be like recorded online or not?
Yeah, it's online quiz. Online quiz. All the instructions is written here. As we are approaching to the quiz week, I will provide more instructions about it. Okay, so nothing, no rush. Don't worry about this at this stage. It's the first class. Yeah.
Okay. And what time is the class tomorrow? Is it 2:30?
I think you can see the timetable on the announcement.
Yeah.
Announcement, go to the home page. The unit homepage. The unit homepage. Here, if you click here, I already list all the timetables here.
Oh, okay.
Yeah, and you can check your official timetable on Star System, right?
because I want to do 2:30 tomorrow. So what class is the way location for? Is that this one?
Yeah,
Okay.
yeah.
Perfect. Thank you.
Okay, hi.
Sir,
Yeah.
I have a question
Yeah.
about like the math lesson.
Yes.
I forgot my scientific calculator in the Philippines and I really don't want to purchase one. Do you think it's necessary for the test?
No. So what I'm going to do is I'm going to demonstrate how to use Excel. Excel,
so you
yeah,
can use it through
yeah. While the instructions how to use financial calculator is provided, but what I want to emphasize is using Excel because I believe Excel is much powerful. As a finance student, we should practice our modeling skills. So I believe Excel is way better than financial calculators.
So
Okay.
like in the final examination, you think Excel will be?
Yeah, yes, you can use Excel. Yeah,
So
no drama. Yeah.
Thank you so much.
Yeah. Any questions? Other questions? Am I clear in class? Okay, great. Yeah. Okay, thanks. Yeah.
Yeah, I think I just got some questions with company tax.
Company tax. Yeah.
So, can you explain?
The company tax is depending on like the scale of the company. If you are super big companies, you do a lot of activities. If your turnover is about $50 million, right, then you have to pay 30% of tax, right? And actually before in Australia, the corporate tax at 30%. So it's unified 30% corporate tax, right? Only in come to recent years, we have to make the threshold. If your activities below $50 million, you pay 26% of for your corporate income, right?
Okay.
Yeah.
If it's about the threshold,
You pay 30%.
you pay 30%.
Yeah. So if like you have a 4% discount if your turnover is below the threshold. Yeah.
Oh, okay. Yeah, sure. I still have questions with the readings. So, what readings you?
It's already uploaded. If you check the topic folder, you can see a reading guide there.
Oh, so is it just a reading material?
The textbook, the textbook.
So are we suggested to read the textbook before?
You highly recommend it. You read the textbook. Okay. I know everything we already cover on the lecture slides. It will benefit if you can understand and read the textbook. That can help us to enhance our understanding.
Okay, but the textbook is like real long and it's
Yeah, every week we only cover like a chapter, 20 pages, right?
So
Yeah.
just finish reading all of them.
It's a recommended, right? It's a recommended, but the key element will be what we cover in class, in lecture class, and also in seminar.
Okay.
Okay?
Okay, cool.
Okay.
Thank
Yeah.
you.